Coming up on the Wheelhouse Retirement Show, find out how the Federal Reserve's decisions have an effect on interest rates and how that could impact your retirement. And in this week's planning tip of the week, Rishi talks about creating a safety net when the markets are unpredictable. Plus, we'll take a look at bonds when inflation's on the rise and how that could affect your safe investments. The Wheelhouse Retirement Show starts now.
Retirement is more than a destination. It's a journey that starts with a dream. A vision for the way you want to live, recharge, and give back. To get there, you need a plan to make your retirement dreams come true. Now in its second season, the Wheelhouse Retirement Show provides you with the essential strategies needed to plan your ideal retirement. From income planning and wealth management to strategies for taxes, long-term care, and leaving a legacy, Rishi Ghosh, Anthony Stryker, and the team at Wheelhouse Advisory Group provide modern solutions and comprehensive plans for your journey to and through retirement. This is the Wheelhouse Retirement Show.
Welcome into the Wheelhouse Retirement Show. I'm Amy Sharp. Joining me today is Rishi Ghosh and Anthony Stryker with Wheelhouse Advisory Group. Always great to be with you, gentlemen.
Excited to be back, Amy.
All right, here we go. Let's talk about interest rates. When most consumers think about interest rates, they may think of their mortgage, maybe their car loan. Is that what we're talking about today?
Yes and no. So a lot of people have been hearing about rising interest rates or lowering of interest rates, and interest rates on car loans, mortgages, even credit cards. As they rise, they're generally not as nice for individual investors because they're paying more to borrow money. But not only does it have an effect on how much you borrow and how much you spend on the money you borrowed, it also has an effect on your investments as well. So controlling interest rates is really the job of the Federal Reserve here in this country.
Right. Tell us a little bit more about what the Federal Reserve does and how that ultimately affects interest rates.
Absolutely. The Federal Reserve is the United States National Bank, and they really have two jobs. They call it their dual mandate. And the first part of that job is to keep employment at a high level or keep unemployment low. So, that's fairly at a low level right now. The real issue that they're seeing is that inflation has been rising fairly rapidly. That's their other part of their mandate, is to stabilize prices, and that has to do with inflation. So the Federal Reserve generally likes to see inflation somewhere between 2 and 3% as a reasonable rate. And that's what they consider stabilized prices. We've seen over the last part of 2021 and into the first part of 2022, inflation on an annual level reaching up 8 to 9%. So we've seen high inflation before, but this is a very interesting environment. We've never seen a difference between interest rates down here and inflation up here. We've never seen that amount of disparity. So that means it's harder for certain individuals, investors, retirees to have money in safe accounts, whether it be CDs, bonds, even savings accounts, and really even have a chance at keeping their money safe and having it keep up with inflation.
So when the Fed comes out, they are raising interest rates. We've seen that a lot lately. What are they actually doing?
So when you hear the terminology that the Fed is raising interest rates, what they're really talking about is a term we call the federal funds rate. Whether people use Bank of America, U.S. Bank, JP Morgan Chase, a local credit union, banks don't just end up with money, right? It just doesn't show up. They get this money from the Federal Reserve, who controls the monetary policy in this country. So when they are raising interest rates, they are raising the rate that banks have to pay the Federal Reserve when they borrow this money. So it almost becomes a trickle-down effect. The more that banks have to pay the Federal Reserve, in order for the banks to make a profit, they now have to charge the consumers a little bit more money. Sometimes they charge them more in the car loans, sometimes they charge them more in mortgage loans. Generally speaking, as Anthony brought up a great point, as interest rates rise, generally safe investments also rise in how much interest they're paying. And bonds could do that, CDs can do that. But as of right now, we're at such a large disparity between safe money investments. I joke about it all the time, but sometimes our banks don't even send us a 1099 at the end of the year because we didn't create enough interest for them to generate that 1099. But that disparity between safe money and inflation is really where people need to focus on how to protect their safe money, but get some growth.
Seems like this could be maybe a little difficult for the average American to wrap their minds around. Is that true?
That is correct. And it's very important for our clients, for our viewers, and the overall St. Louis area in general to understand something like this and really how it affects them. They don't need to know necessarily the nitty-gritty details. They probably don't want to know all those details. However, we do full-on total retirement planning here at this firm. So if a lot of clients have money in safe products, we want them to know how an interest rate raising environment might affect those parts of their portfolio. They could have a serious issue where they have some of their safe money not performing the way that they expect it to, and we want to make sure that they understand exactly why that's happening and how we might be able to fix it.
Over the last few years, people have been coming into our office saying, Rishi, I've left my money in my 401k and I've been trying to create a good balance between my bonds, my equities, my growth portfolio. But during times of volatility, I'm seeing as interest rates are rising and volatility is picking up that maybe it's not performing as well as it used to. My safe money might be losing money, my risk money might be losing money, or hypothetically they might, in a good world, both be soaring. But we're hearing more of the opposite connotation of people are losing money on both safe side money and risk money, and they're not quite sure why. And so much of that has to do with the changes in the interest rate system. As interest rates rise, expenses also rise during that time frame, but as Anthony mentioned, if we can't stabilize the cost of goods and services in this country, then what we have to figure out how to do is how to get people's portfolios to yield more, but yield safely that extra money in order to pay their bills.
Plenty to wrap your minds around, and certainly something that having an advisor by your side, someone like you guys at Wheelhouse, is going to help you through this and to navigate it.
Yes, it's a total retirement planning approach, whether it's investments, whether it's tax strategy or estate planning strategy, that we want to walk all of our prospective clients as well as our clients down this path in order to make sure that whether it's rising interest rates or the Federal Reserve changing their policies, it's not going to have an ill effect on your portfolio.
Absolutely, that's the end goal. All right, thank you so much. We're off to a great start. So much more to come, so stick around. All right, very good. As inflation is on the rise, retirees are searching for help. Rishi and Anthony give us a look at a couple of strategies to wheel you in the right direction coming up. Plus, we're taking a look at the importance of creating a safety net for your portfolio. That's coming up in this week's Tip of the Week. We hope you'll stick around. We've got much more to come.
What does your retirement look like? Is it filled with travel, time with your grandchildren, uninterrupted rounds at the golf course? Or are you too worried about your financial future to even think about your hopes and dreams? Questions about retirement are normal, and the team at Wheelhouse Advisory Group can answer your questions with a complimentary review of your retirement plan. Wheelhouse Advisory Group specializes in helping people just like you prepare for the retirement you dream of. Rishi and Anthony will review your current strategy to expose the potential hidden weaknesses that may exist in your retirement portfolio. Plus, they will explain potential risks and possible strategies to you in clear and simple language. Retirement doesn't need to be scary. Let Wheelhouse Advisory Group help you retire confidently, because every dream needs a plan. Call Wheelhouse Advisory Group now to schedule a visit.
Have you thought about your plan for long-term care? Do you need a policy to pay for it, or can you self-insure? If you have questions about long-term care planning and all the options available to you, you're not alone. I'm Anthony Stryker, and our team at Wheelhouse Advisory Group can help you create a plan to meet your personal needs and protect your hard-earned assets. If you are confused or concerned about planning for long-term care, call us today to learn how to steer your future in the right direction.
Welcome back to the Wheelhouse Retirement Show. We're back with Rishi and Anthony. We're taking a look at inflation, and we're discussing how inflation is a large part of why the Federal Reserve has been raising interest rates, and how that can impact our investments is probably a big piece of this as well. A lot of people have a lot of money in those investments. What are those interest rates doing to them?
So with inflation being at very high places right now, in order to try to stabilize inflation, as you mentioned, the Federal Reserve has been raising interest rates quite a bit, meaning they've been raising the federal funds rate, and hence car loans, mortgage loans have continued to go up. But in terms of retirement planning, this has also had a very large negative effect on what we call safe money investors. Even though inflation may be near an all-time high or very high, right now safe money isn't paying as much. But in fact, a lot of people, when they balance their portfolios, they like to use bonds and bond funds in order to create the safety part of their portfolio, with the old school notion when markets go up, bonds go down, bonds go up, markets go down, or markets go down, but they stable each other out. And for many, many years, those bonds not only stabilized your portfolio, but they paid 4 to 5% interest rates, which is a pretty good rate of return for the safe side of your portfolio. You know, a lot of our retirees like to save their money or accumulate their money through their 401ks, and as they get a little bit closer to retirement, they put more and more into those bond funds, because really within those 401ks, they normally have 20 to 25 different options available to them in terms of investments. And so they start shifting money from those growth funds to the more of the safety-oriented funds. And for the first time in a long time, not only have we seen markets have volatility, but we saw interest rates rise for the first time in 30 plus years. So both bonds started to lose value during that time frame, and equities started to lose value during that time frame. And even though people thought they may have allocated to a very safe portfolio, they ended up losing quite a bit of money in some situations.
Yeah, so these interest rates, the rising interest rates, really can have an impact on your overall portfolio, your overall market value as well.
That's true, and it's a macroeconomic issue, and it affects individual investors, and we want to have people understand exactly how they might be affected. So, like Rishi said, this safe money of bonds and bond funds, which the bond funds are just groupings of hundreds or thousands of different types of bonds. And what the classic 60-40 portfolio for a retirement investor is say you're 60 or 65 years old, is to put 60% of your funds, your overall retirement funds, in bonds. And that's supposed to protect us from stock market volatility. And that would give us the justification, in theory, to have the rest in stocks, in the equities market. And we always know that stocks will probably be higher over the long term, as long as we stay disciplined with our investments and our emotions. However, we're okay with those going up and down as long as those bonds are actually protecting our portfolio, and that safe money is truly safe money. So there is this potential that we've always talked about of when rates are rising, when interest rates are rising rapidly, that bonds can lose value. So if we look at it practically, over the first part of 2022, over the first 6 months, the stock market did have quite a wild ride. The stock market actually fell. The S&P 500 fell about 20%, a little over 20% from January 1st to the end of June. However, we always know that can happen. The bond market, the overall aggregate bond market in the United States, also lost by about 10%. So we're in a situation where the stock market is falling, we're losing money in our risk money, and then we've seen a potentially 10 or 12% in some funds cases decline on what's supposed to be our safe money. So this is really, especially when 401ks are made up of risk money in stocks and just safe money through these bonds, it's going to be a real issue, and even push back a retirement for some investors.
Yeah, I think that's the big question is if we have viewers that they're losing money, they're seeing these losses in both safe money and risky money in their portfolios. What thoughts do you have for them? What are their options?
When it comes to safe money, Anthony and I have said this for years. Safe money doesn't need to make a lot of money in order to make us happy. If it does, that's great. But safe money better not lose money. And we're getting phone calls, and we're getting people coming in through our door, sending us emails from the show saying, I was in these short duration target date funds, whether it's 2025 or 2030, and I thought that was supposed to be very stabilizing because there are a lot of bonds in this portfolio. But unfortunately, and we're not saying bonds are bad by any means, but in a rising interest rate environment, are those bonds really stabilizing your portfolio? So people have been calling us for some different possible options with their 401ks. And option number one, you could roll it over to a self-directed IRA. The biggest advantage of rolling money from a 401k to a self-directed IRA, whether it's retirement or separation from the company or some other triggering event, is in the 401k, generally 20 to 25 different options are available and very limited choices when it comes to safety. 401ks really meant to help people save and accumulate money. But now if it's in a self-directed IRA, you have the entire world to invest in. So whether it would be individualized funds or stocks, bonds, annuities, real estate, gold, commodities, whatever it may mean, you have the entire world. Another option for people that a lot of people don't know is something called an in-service distribution. Upon reaching 59 and a half, I would probably, if I generalize, say 99% of 401ks and sometimes 403bs allow you to do an in-service distribution, which was that rollover to a self-directed IRA while you're still in service at the company. So the 401k would then move to an IRA. You would continue to contribute to that 401k just as you've been used to, and continue to get the match per the company's options. And the biggest advantage, like I said, in both situations, it offers more flexibility in terms of investments. It also offers a lot more flexibility in terms of tax strategies as well. But the big thing is safe money, as we've always said. Safe money needs to be safe money. It cannot lose money, because that's the part of your portfolio that you're going to count on, whether it's for income, whether it's for eventually moving back to the stock market after markets fall, but most importantly, it's going to be there for your family if you need it for day-to-day expenses and month-to-month expenses.
Before making any of these changes and rolling over your funds to an IRA, it is important to work with a fiduciary, in our opinion, to make sense that the fees in your account to the fees you might be paying in another account, and the options that you have between the two are truly in your best interest. So we really make sure that analysis is done before making any type of change.
Okay, all right, thanks guys. Important insights as always. Coming up after the break, Rishi and Anthony will talk about the importance of diversification in your portfolio, and also how their 4-bucket strategy acts as a cushion and safety net for unpredictable markets. That's next in our planning tip of the week. Stay with us.
Have you saved enough to retire? It's one of the most common questions we're asked at Wheelhouse Advisory Group, and you deserve to know. The answer might mean that you can retire earlier than you ever imagined. You've worked and saved for years, now it's time to make your savings work for you. Our team can help you discover how to generate income you can't outlive, plus ways to fight taxes, inflation, and the rising cost of healthcare. Don't delay. Get your retirement income questions answered so you can enjoy the retirement you deserve. Schedule your complimentary 30-minute strategy call now.
Retiring in the 21st century requires more than just claiming Social Security. It takes strategic, comprehensive planning that's tailored to your goals and dreams. At Wheelhouse Advisor Group, we make the process convenient for you with income, investment, tax, healthcare, legacy planning all under one roof. Retirement planning should be thorough and comprehensive, but it shouldn't be overwhelming. Let the Wheelhouse Advisory team design a retirement plan you feel confident about. Get started by scheduling your complimentary 30-minute strategic planning call today.
Life, a series of moments. A touch, a look, a laugh. Successful people. It might not be superior imagination. It just might be superior retirement planning. Imagine what's next. Plan today, own tomorrow.
Many clients and prospective clients of Wheelhouse who have entered the 5-year time window prior to retirement are ready to begin diversifying to safer investments. There are a lot of pros and cons to safe investments, just like there are many pros and cons to more risky investments. Many of the families we work with prefer having a portion of their assets in investments that have principal preservation as the main goal, but make conservative growth when the market goes up. These types of vehicles can help stabilize the portfolio in times of market volatility and economic uncertainty. In addition to safety, the investments we have in bucket number 3 are focused on consistent dividend stocks known as dividend aristocrats. While dividends are never guaranteed, dividend aristocrat stocks are known as the gold standard when it comes to dividend-paying positions. Dividends are key, in our opinion, in helping generate consistent income, whether markets are up, down, or flat. A key belief we have with investment planning is to never risk money that is needed within the next 10 years. With the thought process of putting these funds towards the predictability of buckets 2 and 3, plus some extra funds towards safety for one-off expenses, you can then utilize growth-focused category with your remaining funds and let emotions ride on the sideline, as these funds have a longer time and horizon before they are needed. With the growth-focused category, we prefer to keep costs low by utilizing exchange-traded funds and occasionally individual stock positions. With 10+ years of income for a retired family protected, the risk inside bucket 4 is justifiable, as these funds will not be needed for several years. Each investor has different situation and risk tolerance. Our goal at Wheelhouse is to understand what is the most important to our clients and spend time teaching them the options they have within each asset class and bucket to help diversify their portfolio. By taking this time to teach them these principles, they can feel empowered as they work with our wealth managers to choose the overall makeup of their plan.
That's the planning tip of the week. I'm Rishi Ghosh, and we'll be right back.
What does your retirement look like? Is it filled with travel, time with your grandchildren, uninterrupted rounds at the golf course? Or are you too worried about your financial future to even think about your hopes and dreams? Questions about retirement are normal, and the team at Wheelhouse Advisory Group can answer your questions with a complimentary review of your retirement plan. Wheelhouse Advisory Group specializes in helping people just like you prepare for the retirement you dream of. Rishi and Anthony will review your current strategy to expose the potential hidden weaknesses that may exist in your retirement portfolio. Plus, they will explain potential risks and possible strategies to you in clear and simple language. Retirement doesn't need to be scary. Let Wheelhouse Advisory Group help you retire confidently, because every dream needs a plan. Call Wheelhouse Advisory Group now to schedule a visit.
Welcome back into the Wheelhouse Retirement Show. We're back with Rishi Ghosh and Anthony Stryker. We've been talking about how bond prices and interest rates have an inverse relationship and what that means for your portfolio. Why is this such important information? It seems like it's something we really need to pay close attention to.
So just to recap, we're not against bond or bond funds, but we've just tended to see that over the last few quarters, last few years, as interest rates start to creep up, a lot of people have utilized bond funds within their 401ks or individual investments in order to help stabilize their portfolio. And as interest rates continue to rise, those bonds continue to lose value. And as we've said before, safe money, we're okay if it doesn't make a lot of money, but it better not lose money. And if you're counting on that safe money to produce you income, that also is affected by inflation. Just if we look at very simply the price of a cup of coffee in 1970, it was a quarter. A quarter in 1970 was a lot of money. Quarter now is a lot of money, but in 2022, the average price of coffee is now up to $1.85. Inflation resonates not with just a cup of coffee, but your other expenditures too, whether it's your utility bill or how much it costs you to buy a home or a home in Florida. How do you keep your safe money to not only get you a safe rate of return, but also help you keep up with inflation? It's imperative to have that built into your retirement plan.
You've been talking to my dad about that coffee price? I think you have. It's a conversation we hear all the time. Let's talk about some alternatives that we have.
So we wanted to kind of go back to the basics of bonds. There are a lot of investors out there who are invested in bonds and bond funds and might not even know what bonds are just because they don't do things like this every day. And so really what a bond is a loan. It's a loan to a company that you make. You give them their money, or you give them some money and they pay you an interest rate for however long the term of that bond is. So you can make these loans or have these bonds with corporations. So that's what corporate bonds are. You can have them for 1 year, you can have them for 10, 15, 25 years even. You can also make these loans or have a bond with a municipality, a city or state government. And that's usually where they pay you interest that happens to be tax-free from a federal perspective. And those are another form of this loan or this bond. So on the national scale, there's also treasury bonds. So treasury bonds are loans that you make to the federal government. They have all different types of bonds. So we wanted to kind of break this out into two bonds on the treasury side that are focused on helping investors keep up with inflation. And those are I bonds and something called Treasury Inflation Protected Securities, or TIPS.
Okay, let's start with I bonds. Tell me a little bit more about those.
So I-bonds are bonds that you buy directly through the United States Treasury, and they pay interest based on what inflation is going on. So with inflation being high in the recent quarters, these have now become very popular investments. And the interest, even though there's a lot of misconceptions out there, they're guaranteed for up to 6 months, which means every 6 months, every 6-month holding period, the interest rate changes based on whatever the Federal Reserve determines inflation is going to be. There's an absolute minimum of a 1-year holding period, but realistically, in order to make sure you don't forfeit any interest, you have to hold it for 5 years. Otherwise, you forfeit up to the 3 months of the last interest you earned. The downside of some of these investments is there's a limited amount of money that you can actually put into an I bond. Right now with I bonds, you can put up to $10,000 per investor, or if you did overpay on your taxes and you're getting a refund, through only your tax refund, you can add an additional $5,000. As I mentioned earlier, this cannot be bought through an advisor, through a brokerage house. It has to be done directly through treasurydirect.gov. But it is a good alternative for, as we describe, a lot of lazy money, a lot of safe money that may not be earning a lot of money, whether they be in bond funds or bank accounts right now, to try to get some of that money yielding a little bit more, but help you keep up with inflation.
Okay, and you mentioned another one, and that was TIPS.
So TIPS, and again, that's an acronym that stands for Treasury Inflation Protected Securities. So the way these work, while I-bonds, they change their interest rate based on inflation. TIPS, the actual principal value of the investment, will change based on what inflation does. So if you have $100,000 worth of TIPS that you've bought through the Treasury, then and inflation goes up by 8%, what you would expect is to have $108,000 after that change is made. So the principal value here has changed based on what inflation is doing. Now these can either be purchased individually, just like the I-bonds, directly through the Treasury, through treasurydirect.gov, or it's a little easier to buy these through something like a brokerage house, whether it be a Fidelity, a Vanguard, a TD Ameritrade, or your own advisor. You can buy these, and while I-bonds are capped at that $10,000 that you can buy per year, you can put as much money as you'd like into TIPS or TIPS funds. So these can also be held in IRA accounts, Roth IRA accounts, while those I-bonds, they can only be bought with a non-qualified account, such as a bank account there.
And of course, I want to know which is the best option for me. How do I find that out?
So obviously, we've been doing this show together for a long time, so it's very difficult, as much as I want to give you your answer, to just say, do this or buy this much. But you know already, it's very dependent on individualized situations. People that might be in the accumulation phase of life, meaning too early for the Wheelhouse retirement planning path, they probably don't need too much of safety money based on inflation. Growth is their number one goal. But what we generally recommend, which is the Wheelhouse retirement planning path, is the first step is create the blueprint to your overall retirement plan. We call this our retirement analyzer. It's a software that we've used for many, many years. I used to utilize at the firm years ago. Anthony took it over. Our financial planning team runs it now. Really create the blueprint. But secondly, figure out and poke holes in that blueprint, which we've called our 5 speed bumps of retirement. Find out where are the risks inside of your portfolio, whether it's stock market volatility, inflation, longevity, taxes, long-term care. Solve for those risks in order to make sure you don't have a worry or you don't have a problem in your retirement. And then create a tailored portfolio. Create that tailored portfolio that we call our Retirement Wheelhouse Navigator in order to have a laser-focused approach on solving those risks and having a worry-free retirement.
All right, great show as always. Thank you so much, gentlemen. If you're ready to develop a comprehensive strategy for retirement, don't delay. Reach out by phone or on the web to get started planning for your ideal retirement future. For Rishi Ghosh, Anthony Stryker, and the team at Wheelhouse Advisory Group, I'm Amy Sharp. Have a great week, everyone. We'll see you next time.